Good morning, Adinda. Good morning, everyone. This is Mihai from pitcenters.com. Welcome, guys, to One Day, One Topic. We're talking about timing today, timing analysis. And what I'm trying to do today actually is to have a look directly on my live data system with timing in mind, of course. We're going to look at a few elements of market timing. I'm going to look at entries a point in time when trades can safely be taken, technical patterns related to timing as well, and volatility. This, let's say, three directions into market analysis. I'm going to link them directly to an actual trading system, and we're going to look at the charts. Everything will be directly on the chart, so that everything will have a practical side. I don't want this to be a theoretical session, just let's say a workshop on a trend following system. It can be any trend following system really, but I'm going to talk about mine, of course. And while we're analyzing this system, point out how it uses timing for better performance. Before we get started, any questions, guys? Let me know. If at any point during the seminar you have any questions or suggestions or comments, please let me know. All right. Now, some of you might have seen this window before. It's my live data system. It's on 12 pairs. It has a signal, a short-term trend following system, which I call the STES, and key levels, which are all based on the rainbow. You're going to see the rainbow chart in just a moment, plus directions of the trend on specific time frames, and finally a volatility filter telling me whether the market is safe to trade at this time. As you can see, it looks like the volatility is all right on all pairs except silver. Okay, and this is actually quite directly part of our timing analysis discussion. All right, the volatility filter. I'm going to show you how you can actually determine for yourself if the volatility is right in the market, how we use the hours of the day to, let's say, look for trades or not look for trades, or just skip trades if timing doesn't seem right. And finally, the technical part, of course. Okay, let's get back to the chart. All right. Now I'm looking here at a rainbow chart. I'm using this for practically every analysis session. And I changed a little bit this indicator. I'm using an indicator that colors certain areas of the chart according to certain hours. Okay, so what I would like to do first is simply scroll from one day to the other. Okay, and we're going to look at these segments. I'm going to tell you what they represent, and let's see if we can establish a certain pattern. I don't usually use this session indicator like this. I use it in a slightly different way. I just adjusted for this session just to point out something. Okay. Now, let's see what we have today. Now, this would be right here, the European Open. Okay. London Open is 1 hour after this. Here, where the red starts, it's US Open. Okay. And here it's 2 hours after US Open until what I would say when the volatility dies out in the US session. Okay. And there is a certain pattern that I would like to point out, and how price action behaves in each of these boxes and outside the box as well. Okay, So if you look in general at what price is doing when it's outside these colorful boxes, you will see that in general it's not price action that's conclusive to the trend or to the market direction at that time. As you can see right here, price has gone inside the rainbow, which is basically a larger, an extension of the correction. And this would be what I call a typical price action. Okay, during the times when I do not trade, I'm actually sleeping at this time most of this time, but I don't like trading even if I'm awake. Okay, it's after the U.S. volatility has dried out, and of course, Asian session can be interesting sometimes. This is the no trade zone as far as I'm concerned, but I'm not really trading Asian session either, so for me it just go together. And you see that nothing is really happening during this window of time. Look at this. Perfect nothing here. Market going up and down, up and down. Even the rainbow suggests that the volatility is lower. Okay. Price is staying within a very narrow range. Look at this. Well, here, this is after the weekend gap. So we had that strong volatility on Friday, and then after this spike, we had nothing. Price action just died, and then we started this correction during the London session. But it started actually the week started very slow. Look at this. Of course, it's not valid for each and every day, but you can tell that there's certain inactivity in the market around these hours. Look at this. Okay, you can check this on your own chart. It starts with, let's see, this is actually 6 p.m. GMT, 6 p.m. GMT until 6 a.m. GMT. Okay, I think the point is made. I mean, we look at the chart and we see that basically price is not doing that much within this time period. So it's one thing to keep in mind, and it's indicating a certain time of the day when, in my opinion, there's not much incentive to trade. You're not going to have much volume, and the market is not usually doing something decisive, something, let's say, it doesn't change direction. It doesn't really give you a strong move like it happens, for instance, here after European Open or during this nicely active day. Look at this. Complete flat price action with absolutely nothing interesting. But look at what had happened right before during the European session. All right? So I would separate, I would distinguish within a trading day in terms of timing. Timing understood as the times of the day when we like to trade, when I like to trade, and when I do not like to trade. So this would be the first area, the no trade zone, which is late US and early Asian session. Now what comes next is European/London session, okay, until New York Open. Now, of course, it doesn't work all the time, but you will notice that there is a certain market dynamic within this very active session that somehow starts not exactly at the beginning of London session, okay, but somewhat maybe 1 hour after, say half an hour, 1 hour after London Open, which is roughly on my chart 11, all right, somewhere around here, and lasts until right before or right at New York Open, okay, and this would be the red zone on my chart. Now here's a big move. Let's see what else we have. Again, the market has been retracing, but then giving the biggest chunk of the price action towards the upside in the direction of the trend. Okay, and something happens when the red area of the chart kicks in. Same here. just the direction is down. Something happens within the red area. This is a bit of a more of a choppier day. Okay, not an easy day to trade, but something happens definitely within the red area. But here, for instance, price hasn't stopped, hasn't peaked right before New York Open, but earlier than that. Price sort of bottoms right before US Open. Price tops right at the beginning of the red area. Price stops right an hour before. Price stops for a while at least. Makes a correction right here at the beginning of US session. Very close to the peak here. Very close to the bottom here. And let's see what we have today. Well, there's still some good 3 hours before New York Open, so we might see some more downside based on that. All right? What I'm trying to say is, within this green zone, you can expect some indecision at the beginning of the square, followed by what I would call the theme of the day, the direction of the day during London session, which, well, can be more or less well sustained, but it will sort of dry out, pause, or reverse either exactly at New York Open or close to that time. Okay? So another factor to keep in mind. Now, when you're trading something like the rainbow, and there isn't much to tell you when to exit, because this is a trend following system, it will give you an entry, but the exit you will have to figure it out for yourself. So timing becomes very important, because you obviously you want to catch a top or a bottom. You want to be out of the market right when your profit loss is at its peak. Of course, when your profit is at its peak, so you will want to get out at the right time. But the trend itself will not tell you, for instance, when you're trading with the trend right here, the rainbow is wide open, volatility is very good, everything is going along just fine when price enters the red zone. Okay? So sometimes the simple fact the price is entering the red zone is, or can be, good enough reason for you to either book some profit, manage your trade somehow, or even completely take out the trade. Sometimes, for those of you who are counter-trend traders, this can actually be interesting in determining points where you can reverse your position. Now, if you want, just get a chart and get this indicator or whatever indicator draws some areas on your chart according to market hours, and you will see how often reversals take place within this hot zone right after New York Open. Now, right here, you have a reversal right at this point. Reversal. Actually, it's a correction in this case. Look at this. Very big move, very big. Yeah, it's a reversal that was going on here. This was on Thursday last week. All right. Of course, it was caused by fundamental. Okay. This was fundamental. It was a discourse by Draghi, if I'm not mistaken, that dropped the market immediately, huge amount of pips. But it happens within this time zone. All right. So the second area would be the green area of the London session, right until the red of the New York session kicks in. Now, this would be the time when, personally, I like to stay out. Okay? I like to not trade during this 2 hours following New York Open. That's because, well, you do have a good movement. Most of the time you have good movement. I mean, look at this. Alright? You have a pretty good move and then a pretty good drop as well. But what I would say, and for me it's important, I'm not sure how you guys trade, it's not necessarily the thrill of getting into the market when you know something's going to happen that makes me tick. It's more being into a move that's stable enough, at least that I consider to be stable enough to keep me going and not to have this sort of correction, because basically I like the technical part of this setup very much even. There was a breakout, there was a comeback very close to the bottom of the rainbow. There's the rainbow protecting us for longs here, and there are spikes, okay, at a time when I expect something to happen. So yes, longs are to be expected. But this, I could have been very well into a long right at the very best moment. But just as well, I could have been stopped out at break even after this drop. I might have stayed into the trade, okay, after it started. This was a good 20, 30 pips we're talking here. And I might have been fooled by price action, by strong price action combined with good technical setup and good volatility to continue this move. And I might have set my stop to break even, okay, take a very good trade, set my stop to break even, and then be stopped out, and then price would make still a higher high, and it would be frustrating, okay? So what I do is basically allow the market to do whatever it wants to do during these 2 hours. Now, it's not, of course, a very fixed time. It's not always precisely 2 hours. It can be 1 hour and a half, but it's not within the 1 hour following the New York Open. That's for sure, okay? It's not within the few minutes that follow the Open, because that's when you can expect whipsaw. So this, for me, is an interesting area of the chart. It's where many pips are made or lost, but I'm not that much interested to trade. And finally, there's this area, and we're talking here about 4 hours. Okay, 4 hours of good volatility, and usually, and this is what I want to stress, stable and one direction price action. All right, price tends to be quite stable, and it tends to follow one direction instead of going up and down as it tends to do within the red zone. Okay, now you will see, for instance, this is not a very good example. Price has dropped here mostly due to fundamentals again. Okay, and most of the interesting price action happened within the red zone. And of course, if you look at this, you would say we should have been in at this point. But frankly, I prefer entering around here with a good setup, clearly on the trend, good timing, and good volatility for just about 20 or 25 pips, okay, which I might have been able to squeeze in, instead of trying to go here for a trade that I might not be so sure about. Okay, the level of confidence for me in this area is just lower. But when the market does something, okay, and especially when it makes a low or a high during the red zone, you can expect the blue zone to be more predictable, in the sense that wherever the low or the high is, right after this blue area starts, that might be the actual low or high of the session. Now let's have a look. Look at this. Okay, price has made a significant retracement, okay, during the 2 hours following US Open. It dropped, and right here I have everything here. I have a technical setup. I have the trend in my favor, definitely a signal. Good timing, good volatility because the rainbow is nicely open, okay? And the result is, in this case, perfect, because the market does not retrace and doesn't give me any sort of surprises, and I'm taking the biggest chunk of the price action during the New York session with stop not further than the high at the time, okay? So trading can become very simple in terms of, just because I'm in at the right time, I simply go with whatever flows there is in the market at that moment and set my stop at the high or low obvious at that time. Look at this. Now the market's dropping significantly here. This is not a good technical setup according to my system, so I wouldn't have been cleared for a long, but not all of us trade on the same scenarios. But basically this indication of good price action within a few hours, one direction without surprises, and stop at the low at that time seems to be verified very well. We're talking about 40 pips. Okay? After the volatility of the first 2 hours is gone. Now here we have a pretty stable trend happening during the entire day. Starts during London session. Okay? The market is going with the trend, lower lows and lower highs, pretty good price action, pretty good momentum, volatility. And right after New York session, it collapses again. Okay? But something's happening after this. So you're practically catching the correction after the market bottoms within these 2 hours. So if you just step in and you see the chart at this point in time, okay, at 515, that's 2:15 GMT. Okay, the low is never touched. The market makes a bit of a move. Now, considering that you're against the trend, I would consider this to be a pretty good trade. But you're obviously not going to have your stop anywhere lower than a few pips below the previous low. So that's not going to be a high risk. It's a counter trend move that works really well. And it's a no-brainer really. It doesn't really follow much except simply timing. Simply being in the market at the right time. Look at this. Market's doing a spectacular move here, a spectacular drop within these 2 hours. And if you are just entering late and you're following this, you will be short. I'm not saying it's a bad direction. It's still with the trend and it's within the parameters of a short signal. But basically, these are good pips to be made. And it's about 50 pips. And they can be made just by stepping in at the right time, 15 minutes after this period is, after this red square is over, with stop at the previous low. That's just what it is. Here as well, the low is pretty far away. So I think in this case, the market has bottomed a bit earlier. As I said, it doesn't work all the time precisely to the minute, but it's still the market doing something else than what it started doing during this, right after New York Open. This is a very, very good example. Market keeps dropping. After it makes a low, of course, you wouldn't enter at the very bottom of it. You'll enter maybe here or even higher, but it's still good price action with stop at the low of that session. This is the perfect example right here. So market's been retracing abruptly, breaks the top of the rainbow and sets a new direction which is long, pulls back to the bottom of the rainbow again, all the technicals are in place, and goes up to re-emerge on top of the rainbow, with the timing indicating that this would be a low for the entire session. They're taking pretty good pips, 30, 40 pips. Guys, what I want to say is I'm not really using timing to get in. I'm using all these timing configurations more to stay out or to exit the market. For instance, if I have a trade that's in the right direction and I'm right at the beginning of New York session, I might take it out for profit before it hits my stop. I'm not entering against the trend just to play with the hours. It's more taking some profit while it's still there before something happen to ruin my trade within this danger zone, or maybe if I'm not into a trade and something happens and technically I sort of like it, I'd rather skip the trade until I enter the comfort zone of 1 hour and a half, 2 hours after New York open. Any questions so far, guys? Does any of you use timing in this way for entering and exiting positions? I'm actually quite interested to develop this a bit further. Maybe, well, on one side to apply it to the system, because my system does use timing, definitely, but it's sort of embedded within the dynamic of the rainbow. No one using timing? All right. Let's see a bit further. Look at this. You have the market doing something pretty weird during this time. Yeah. Well, Aroma, this is not really, it's not an indicator per se, it's more of a tool. It doesn't give me anything technical, it simply draws some colors on the chart so I can see better, because right now, since I'm going back on the chart, I cannot look at the time, for each candle, but this will tell me exactly where the market, what time it was when the market is doing a certain move. Oh, okay. Yeah, so 80, I think that's about precisely what this green box is. Well, the rainbow is not an indicator, it's a template. So it's basically lots of moving averages put together and saved as a template. It's called the rainbow template. I think if you Google it, you'll be able to find it easily. If not, just email me and I'll be happy to send it to you. The rainbow is more the technical part of this system. Today I wanted to talk more about timing and about these hours, because I never have the chance to do this. When we're analyzing the market from a technical perspective, it's always direction, levels, long or short. But this is actually quite interesting, because I know a trader who doesn't really care much about technicals and simply uses the time of the day. So instead of looking at indicators, the guy looks at the clock. And well, I can't say I'm fully, I would be fully comfortable with that, but many times it works, because after some time and some experience with the dynamic of the market, how the market moves, and if you're always trading the same pairs, you will know more or less how they behave. You know that if a certain time has come and nothing has happened, for instance, at this point, okay, let's just analyze this point of the chart, because it's not a very easy moment right here. We are into a bearish trend before we enter this European session, right? Price hits the top of the rainbow, comes back to the bottom of the rainbow, so it's just looking for direction, breaks the rainbow to the upside, okay? At which time I'm starting to think long, all right? Price comes down, okay, to the 200 moving average, towards the bulk of the moving averages. And this would be where a long signal would be activated on my system, meaning that there will be enough time that market has passed within the bullish rainbow, the freshly confirmed bullish rainbow. As you can see, there's the red moving average here and some yellow. And this for me is a bullish confirmation. So this would be a bullish signal. Okay? What I'm saying is difficult because it doesn't really work out. Okay? Now my stop would be right below the bottom of the rainbow, the last moving average that I see. Personally, I use a really relaxed stop. So if this is the level I'm interested in, 62, my stop will be somewhere on 42. Why? Because I do not like to be stopped out by a spike precisely to that point. Okay? So this would be an emergency stop. If the market breaks, then it doesn't matter if it hits my stop or not, I just close. But if it doesn't hit my stop and it doesn't break the bottom of the rainbow, I will just assume that it's spiking at this point, and I wait, okay? It goes up again, and I'm getting confirmed into the trade, and it looks pretty good. Now there's this thick moving average here telling me that I'm at the top of the rainbow on the 30-minute chart, and that's not usually a good sign, but let's just assume that I'm ignoring that, okay? Now there's still enough time, and I'm always considering this, if I'm entering for a short-term position. Is there enough time for the market to hit my take profit, which would be somewhere around here? Alright, I entered at this point around 80. I would look for about 25-30 pips. My risk is about 25-30 pips. So this would be the target that I'm looking for. Well, is there enough time? At this point, I would say there is. There is 1-2 hours. So if this price action had gone up in the direction of the newly confirmed trend, I would have had my take profit hit. But things don't work out. Alright? So what happens here? I'm probably going to close the trade for a loss around 22.60. Okay? A trade opened about around 80. I will close it with about -20. Okay? Even though at some point I had been in profit, but it's alright. This is what the rainbow is suggesting. One moment. Alright. And the market is going into this very tight rainbow in this zone. And we're going into the red area. Now, I can tell you for a fact, I would not trade this area. Either long or short. Now, why is that? Because first of all, the timing is not right. I'm in the red zone, and I'm not into a trade. I was just stopped out, or I just closed the position with a loss. Okay? I will not re-enter position while the market is still in the red zone. That's number one. Number two, look at the distance between the bottom of the rainbow and the top of the rainbow. Now what does that tell you? You can't even see, the colors are all mixed together here. You can't see which is which tells me the MAs are all together, the 200 moving average, all the way down to the 5 moving average, okay, on this time frame, are all together within a very, very narrow, I think 10 pips, less than 10 pips corridor. Okay? What does that tell me? That there isn't a good direction in the market on this time frame. Okay, and this is my key time frame, the 15-minute chart. So for short-term trading, I have nothing, absolutely nothing. And this is why this breach, even though it's not even a technically good breach, means nothing to me. Okay? I would simply wait for the right moment. Now, if you wait for the timing to be right, okay, and simply ignore anything that's going on within the red zone, and you start looking at the chart starting with the blue area. This high at 83 is the high of the session. And not only that, it's actually a high for many, many sessions. So those of you who like entering risky trades for risking peanuts 10, 15 or 20 pips for, I don't know, whatever, 100, 200 pips, and sometimes going strictly on luck, okay, probably are using timing very, very well. Because, well, you would say that you are lucky. Okay, you enter a trade here, the stop is at the top. Well, it's not luck if we do this knowing that there is a chance, let's say maybe 20% chance, that this would be the high of the session. I think the chance is more than 20%. And then you just wait, and the market gives you something. Now, many times, at least, I don't know about you, but when I was in my losing days, I found myself making a lot of good small trades and finding myself into one big losing trade. And for a while there, I was thinking, man, I'm unlucky, because I'm always on the right side of the market, except for one time when the market goes against me, okay, like 300 pips. And in fact, what I was actually ignoring at the time, and I understood later, it's not bad luck at all. And in a similar fashion, if you are profitable 300 pips, it's not because of luck. It's because of careful calculation. And you're bound to have one of those big losses if you're always targeting 10, 15 pips, because you do not see what's happening to a trade beyond 10 pips. Okay? The trade can always reverse. And because you're always taking profit very quickly, you do not get to have the market, the small probability of the market, about 10%, to go against you. Okay? I think you can just simply open a position on a demo just randomly and have a take profit of 100 and a stop of 20. Okay? Clearly the probability of the stop being hit is much higher. But if the other side happens, well, that's a really big profit. And similarly, if you're against, that's a really big blow. All right? What I'm trying to say is timing can help you to tip the scale in your favor at a time when it can be essential, especially if you are trying to pick tops and bottoms. It's not really my game when I trade. I'm really not much into that, into trying to pick tops and bottoms. I'm rather into trying to join a good move, somewhere in the middle or towards the end. I'm not really trying to be the first guy at the party. But if this is how you trade, and many traders do that, many traders try to pick the top and the bottom, timing can be a very good factor in your favor. You can see that if you just see how these areas of the chart provide very good highs and lows for the entire session. Look at this. I don't know if I looked at this before, but it happens over and over. You see? When you look at the chart 15 minutes after this 2 p.m. GMT, the low that you have is the low of the session. And the market reverses. Here, you actually have the same thing, but in the direction of the trend. A reversal, but it happens here. You see? It happens at this point. This is maybe a bit of a more complicated. I think this was caused by fundamentals. So probably the market was cautious at this point. Nothing much happened. Or you can call this a loss. Okay? You will probably go in long and you'll be stopped out here. But there aren't too many instances of this happening. Alright? So the first point, and I just want to draw some conclusions here on this first point. It does matter what time it is when we trade. Okay? It can help you to not be in the market exactly when the market tends to make changes in direction. And I would especially point to this 1 hour period after the New York Open. Especially when you're trading a trend following system like this rainbow. For instance, here I would have been definitely on the short side. Okay? So any entry at this point would have had me entering short at the bottom of a move. So I would be in the market at exactly the wrong time. Okay? If, on the other hand, you are trading counter trend, if you are the sort of trader who constantly looks for tops and bottoms, this period of this time of the day can be your golden opportunity. Okay? Because many times you see reversals, you see peaks and bottoms within this 2 hours period. And this can help you. Even without any other sort of technical pattern. Even if you remove the rainbow altogether, just look at price action and the time of the day. That's it. It can give you very valuable information. Alright. Now these would be, in my opinion, the times when you can trade, let's say, safely. Actually, the green square should be pushed a little bit more, because this would be 6 a.m. GMT, and that's London Open. Okay? Is it 6 or 7? I think it's 6 a.m. GMT. I do not like entering exactly at London Open. Whatever first 15 minutes candle I have, after London Open, it's not necessarily conclusive for me. Okay? If price action continues to do the same thing after 1 hour, then I would consider that to be more relevant. Now this is the non-farm payrolls day. Okay? And this would be the candle right at the release of the news. Of course, you will say, definitely this was news driven. Yes, it was news driven. But definitely the rainbow was indicating something. And this was definitely a good long setup on the rainbow. Alright, look at how volatile the market can be within this area and still within the blue area when most of the price action has already happened. But look how much you can still make. In this case, it was about 70, 80 pips safely in the direction of the trend without having to guess and without having to have such a 50-50 probability when you enter. This is a much more than 50 probability because basically the direction has been started. So you are at a time when the market does not tend to reverse or to make spectacular moves against what it's been doing until then. Okay? Less of that than usual. I think overall we're still playing with on a probability game here. I think this wouldn't be a very good example because the market has been in a very tight rainbow, and I'm sure this was news driven as well. As you can see, about the same pattern. I think we talked about this setup in the past. Now I want to go to the second point when it comes to timing. Another way of understanding this concept of timing would be from a technical perspective. Okay? Now, timing for me from a technical perspective means the right moment within a certain setup when I am allowed to go in. Okay? Now, my system, for instance, let me show you a little bit. Alright. My system gives me a trend direction. One moment. A trend direction, the key levels, the volatility situation, okay, and individual trend direction. What I'm using most is the signal, which is a proprietary formula that I know well, so I know what it means really, and it's placed a lot on these key levels. These key levels are the rainbow translated technically into numbers, okay? And what I'm doing is just simply one thing, playing with the levels and the signal. For instance, let's just talk about what we have right now on the euro dollar, right? The euro dollar turned bearish. I think I can tell you precisely. Let me reload the chart. Okay. I think I can say the rainbow turned, the signal turned bearish around this time right here. Not here, but around here, about 23.55, let's say. Okay? 23.55, my system was indicating short on the euro. Now I have an expert advisor that's already taking a position for me if I wanted to do so. But many times I choose to manually intervene by adjusting the position according to certain parameters. And then I go back to the table and I see what are the key levels. Now, these levels were broken. Okay? 1 second, I'll just reload. Alright. Now, these levels of support were broken, and this is why the signal is turning bearish. It was not 87%, it was somewhere around 65% at the time. And the resistance levels are starting to appear. And I have 23.66, 71, 81, 80, 72, 65. Now what do we see here? I'm not sure I have time to go into all this technically right now, but I see levels between 2765, which is very far away from this zone. It's a daily level anyway, and 2366. Now, what I'm looking for is a confluence. I'm looking for many levels that are very close to each other, forming a very tight area. So from 2366 to 2760, this is of no good, of no use. And we're talking 400 pips. Definitely, I'm not going to use this level. But I'm going to use these from 66 to 81. Now, let's go back to the chart. All right. Oh, sorry. Okay. Now today we're talking 66 to 81. All right. Now this would be the area of resistance, and this would be the area that defines the short signal. As I told you before, the short signal came somewhere around here, 55. Oh yeah, okay. All right. Now this would be where the signal came out short. And this would be the area that I define as my technical resistance area. Now what does timing mean for me, technically? It means that if the signal is somewhere around here, the timing is not right because the difference between current price and the highest point of my resistance area is too large. We're talking 50 pips here. And my stop would have to be, I'll just make it, okay, let's use green, okay? This would be my stop at 23.90. The timing is not right if price goes all the way here and my signal is here. Now sometimes it can happen very fast and I don't have time to get in, I don't have time to analyze. So I'm simply getting a short signal at this point. I'm looking at the level and I identify this as a short signal that doesn't have the right timing. Why? Because it doesn't give me the area. It doesn't give me the edge of entering at the right time. Now what would the right time be? Well, the right time would be if it corrects very close to this resistance area. So my stop would have to be reasonable, okay, for an intraday position. So if my entry is 60 and the high of my resistance area is 81, my stop is 90 just to be safe. That gives me a stop of 30. The possibility of me making 30 pips in the direction of the trend on a signal confirmed is definitely more than 50%. So I'm having a trade with a probability higher than 50%, with a risk reward that's at least 1 to 1. That's acceptable. As far as I'm concerned, that's a go. But if my risk is 60 pips and my target is 20 pips, even if the probability is 60% or 70% for that trade to work out, it's a no-go. Simply because the timing is not right. Now, you will say probably, all right, what happens when you have a signal, you do not go in, okay, because you don't have the right timing, and the market collapses to 100 pips? Well, the answer is quite simple. I just lose the signal. I skip the trade. I don't make any money, but I do not lose anything anyway. So it's not so bad. I'm not affected in any way. And even if I do make profit on one trade, that's not necessarily the most important thing. It's when you step in and you take the risk and you are with the cards on the table, you are either going to make a profit or suffer a loss. That balance of probability and risk reward has to be acceptable. It doesn't really matter if you are taking a loss or you're making a profit. It matters the time when you go in, the decision to take a chance on that trade. And it should be based on a reasonable, sound balance between probability and risk reward. So, as far as I'm concerned, this is what timing is all about technically. To find a spot within your technical pattern. In my case here, it's a trend. I'm trading with the trend with a short-term 15-minute trend. Let's just simplify things to that extent. So I don't care for anything else technically than buying above the rainbow and selling below the rainbow. That in itself is not too complex, but it should be enough. All right? But that's not all. That is, let's say, the backdrop of your trade. The backbone of your trade is the timing. And what you do is set an order at the level where you consider that this trade is a good deal. And again, it doesn't matter what comes out of the trade. You shouldn't say, yes, I was right, or no, I was wrong. It doesn't matter really. You know the overall probability of the system, and you know that risk reward was good, and you know that the timing was right. And that makes it right. Of course, you still have to watch your equity over a longer period of time to see if the system and this methodology works. It has been proven to work for me. And, well, each of us finds something that works for them in the long run. But what I'm saying is it's not the result of an individual trade that will decide whether you are right or wrong. It's the way you enter that matters, not the result of the trade. All right? And this will be the second point, the technical part of the setup. I have to wrap it up, I think, very quickly and going over the third element. And I'm just going to mark some areas of the chart. Let me remove the horizontal lines. Now look at the market at this point. Look at the market at this point, at this point, and even at this point. It's what I was saying before. It's a very, very tight range of the rainbow. The rainbow has this. It's lagging. Obviously, it's a lagging indicator because it's a lagging system because it's based on a lagging indicator, which is the moving averages. But even if it's lagging, it tells the truth. Okay, it will not tell you about the future, but it tells you very accurately what here at this point, and that the market is stuck in a tight range. This is not about predicting the future or where the market goes next. It's about an actual fact that you just simply have to see and to identify. And that means you do not know where the market is going, and the probability and the risk, the probability of success of your trade decreases. The risk increases because there's much more unknown in your trade. And because your stop would have to be very, very tight, which makes it very vulnerable. All right? So whenever the rainbow is very tight, as in these areas, this for me is a sign of bad timing. Bad timing because of volatility. All right? The volatility is not right. The market doesn't have the flow that you need, okay, to get the trade where you want it to be. It happens many times after this very tight range for the market to break out spectacularly one way or the other. That's true. And after the fact, it's easy to say, okay, I should have been long here, I should have been short here. But basically, when you're looking at the chart in real time, you will see that it gives you this feeling of insecurity, of lack of safety and control, because you know that at some point, you see, at this point here, market breaks up and actually drops. So you can have your stop hit on the upside, and still you'll be right. So it's just, for me, it's a really high risk chart setup. Look at this. And it's actually confirmed by price action going up and down, up and down. And until the rainbow opens up, you don't have a smooth flow of the price. You have jerky movement. All right? So, guys, to summarize all this, we talked about three things today. We talked about the time of the day corresponding to these colorful boxes when trades are more likely to be safe and more likely to get you where you want for reasonable risk than other times. Okay? So time of the day. Second, the technical part. That means we were talking about today's setup short, being in the market at the right time or not be in at all. Be in the market when the risk to reward is right. And for me, the first thing that looking at the clock ensures that I'm avoiding whipsaws and I'm achieving some stability in my trading. Number two, the technical pattern gives me the risk to reward, which is a key element for any trade. A good timing, a good technical timing means increased risk to reward for the trade. Finally, the volatility factor gives me the profit potential. I want to be in when the market gives me potential for something happening next, something that I can see, I can identify. And I'm avoiding flat markets. Flat markets are not good. At least for a trader who's looking for more than 5 or 10 pips. Flat markets are just, let's say, neither here nor there. It's a moment when you're not getting the edges on your side. Okay? Think about all this if you want. Think about it as a cake that you would put in the oven, and you need 3 ingredients. You need the right time, the cake should be in the oven for the right amount of time. Otherwise, it will be either overbaked or not baked enough. It has to have the right ingredients. I mean, everything that you put in the cake is the technical part, the technical side of the chart. Okay? The right trend, the right risk to reward. That ensures that what comes out after some time is something good and not something that tastes bad. All right? And thirdly, volatility is the flow, the fire flow that you use to bake this cake. You need the market to give you that constant, stable, safe flow, all right, to get the baking done slowly and nicely. Otherwise, if it's just too low, it simply wouldn't bake, regardless of the other factors being there, regardless of good ingredients, regardless of good, let's say, the right amount of time spent in the oven, it will not bake. All right? So it's something I'm actually using it's a symbol that I like to use for myself, knowing if I'm getting into a trade, is this cake going to come out nicely? That's what I'm trying to think. And putting these factors in together, I'm just trying to increase the probability of this, of the trade working out well, of the cake to come out nicely. Any questions, guys? One moment, I'm just going to load up something, just in case you need to email me or for anything. Okay. All right. If there are any questions, let me know, please. This is my email address. Feel free to drop me a message if you have any questions that you haven't thought about. If you want to have a look at the live data system, you can check it out in real time here. There is always one pair open for free for the entire week, so you can actually see both the signal and the levels at work in real time. All right. If there are no other questions, I'd like to thank FX Street for this session. Thank you guys for attending. And I'll see you at the beginning of September for our regular technical analysis session. This is Mihai from Bitcentive.com. Thanks again. Have a great week. And I'll see you in September.